Income statement. This report shows a company's revenue, the amount of money it earned from its operations, and expenses, the money it spent to operate, over a specified period of time, usually 1 quarter or 1 year. The difference between revenue and expenses is the company's net income, which indicates whether the company made a profit or loss during the period. Balance sheet. The balance sheet provides a snapshot of a company's financial position at a specific point in time. It lists the company's assets, what it owns, liabilities, what it owes, and equity, the residual interest in the assets of an entity that remains after deducting liabilities. The balance sheet helps you understand the company's liquidity, its ability to meet its short-term obligations, and solvency, its ability to meet its long-term obligations. Cash flow statement. This report shows how much cash a company received and spent during a specific period of time. It also shows how the company's operating, investing, and financing activities affected its cash balance. The cash flow statement helps you understand the company's ability to generate cash and its overall financial stability. Footnotes. The footnotes section provides additional information and context to help you better understand the financial statements. This may include information on accounting policies, financial risks, and transactions with related parties. Financial ratios. Financial ratios are used to analyze a company's financial statements and compare its performance to other companies in its industry. Some common financial ratios include the price-to-earnings ratio, PE, the debt-to-equity ratio, and the return on equity, ROE. It's important to keep in mind that financial reports can be complex and may require some understanding of financial concepts and terminology. If you're new to reading financial reports, you may want to consult a financial advisor or professional for guidance. Additionally, it's important to review financial reports over a period of time to get a complete picture of a company's financial performance and health. An income statement, also known as a profit and loss statement, is a financial report that shows a company's revenue and expenses over a specified period of time, such as a quarter or a year. The purpose of the income statement is to show the company's profitability and provide information about its operating performance. In this example, the company's revenue is made up of sales and other income and is shown at the top of the income statement. The expenses, including the cost of goods sold, salaries and wages, rent, utilities, advertising, and depreciation, are listed next. Finally, the net income, profit, is calculated by subtracting the total expenses from the total revenue. It's important to note that the income statement only reflects a company's performance during a specific period of time, and may not provide a complete picture of the company's overall financial health. It's recommended to review the company's financial statements over a period of time and in conjunction with other financial reports, such as the balance sheet and cash flow statement, to get a more complete picture of the company's financial performance and health. A balance sheet is a financial statement that provides a snapshot of a company's financial position at a specific point in time. It lists the company's assets, liabilities, and equity, and shows the relationships between these three components. The balance sheet provides information about the company's liquidity, its ability to meet its short-term obligations, and solvency, its ability to meet its long-term obligations. There are several types of stocks, including common stock. This is the most common type of stock and represents ownership in a company. Holders of common stock are entitled to vote on company matters and usually receive dividends. Preferred stock. Preferred stock typically does not carry voting rights, but has a higher claim on a company's assets and earnings than common stock. Preferred shareholders usually receive a fixed dividend. Growth stock. Growth stocks are shares in companies that reinvest their earnings back into the business to finance growth, rather than paying dividends. Income stock. Income stocks are stocks that pay a steady stream of dividends, providing a regular source of income to shareholders. Blue chip stock. Blue chip stocks are shares in well-established companies with a history of stable and consistent growth, a strong brand, and a good reputation. Value stock. Value stocks are shares in companies that are considered undervalued by the market, and are usually bought with the expectation that their value will increase in the future. Cyclical stock. Cyclical stocks are shares in companies whose performance is tied to the ups and downs of the business cycle. Defensive stock. Defensive stocks are shares in companies that are less sensitive to economic cycles and provide stability during economic downturns. Now, let's take a deeper look at dividend-paying stocks. Dividend-paying stocks are a type of stock that pay regular dividends to their shareholders. The amount and frequency of dividends are determined by a company's board of directors and can be changed at any time. Some companies pay dividends on a quarterly basis, while others pay annually or semi-annually. Dividend-paying stocks are often favored by income investors, as the regular payments provide a source of passive income. They can also be a good choice for risk-averse investors, as companies that pay dividends tend to be established and financially stable. However, it's important to note that just because a company pays dividends doesn't necessarily mean it's a good investment. Dividends are not guaranteed and can be reduced or eliminated at any time. Additionally, a high dividend yield may be a sign that the company is in financial trouble and is trying to attract investors by offering a higher yield. When evaluating a dividend-paying stock, it's important to consider the company's financial health, dividend history, and future growth prospects. It's also important to look at the dividend yield in relation to the company's stock price and the overall market, as a high yield may not be sustainable in the long term. Dividend yield is a financial metric that measures the amount of income generated by a stock in the form of dividends, relative to its current stock price. It's expressed as a percentage and is calculated as follows. Dividend yield equals annual dividend/current stock price. For example, if a stock has an annual dividend of $2 per share and is currently trading at $50 per share, the dividend yield would be $2/$50 equals 4%. The dividend yield can be an important consideration for income-seeking investors, as it provides a way to compare the potential income generated by different stocks. A high dividend yield means that the stock is paying a larger portion of its earnings as dividends, which can provide a steady stream of income to investors. It's important to note that a high dividend yield doesn't always indicate a good investment opportunity. Some companies may have a high dividend yield because their stock price has declined, which can be a red flag. Additionally, a company may have a high dividend yield because it's paying out more than it's earning, which is unsustainable in the long term. Therefore, it's important to look at other factors, such as the company's financial health, dividend history, and future growth prospects, before making an investment decision. Additionally, it's important to consider the overall market and interest rate environment, as higher interest rates can make fixed income investments more attractive, reducing demand for dividend-paying stocks. For example, if two companies have the same earnings per share (EPS), but one has a higher dividend yield, this may indicate that the market perceives the company with the lower dividend yield as having a brighter growth potential. As a result, the market is willing to pay a higher price for its shares, which reduces the yield. In this case, the lower yield may still be the better investment opportunity.